Once you're ready, we can proceed. Okay. Yes. So I wanted us to look at each that hypothetical balance sheet and to try to identify each of these types of risks, and also to show or to try to look at the strategies that, for example, the Treasury Department can take to be able to mitigate or hedge against such risks. So let's look at we'll look at each line item of each asset and liability in the mix of the NBM portfolio. So, for example, the short-term loans and savings deposits, those are the related ones. We look at the ones that are related. So, for example, the short-term loans in this case are 200 million, and let's say those are repriced, or those are they are sensitive to the floating rate, right? We said they are floating rate, and so these short-term loans, while the savings deposits, because those are, we look at each line item to which rate sensitive item it corresponds to, from assets and the liability sides from each side. So the short-term deposits are 200 million. We can include the cash and cash equivalents of 50 million that are to be paid in the short-term loans at a floating rate of a floating rate. Let's say a floating rate is can be even of the soft overnight lending rate. Yes, that can be the floating rate that we can reprice them at, and also the short-term deposits. So the savings deposits, I mean, of also 200 million that are also at, let's say, a fixed rate. So we can reprice deposits at a fixed rate, but the short-term loans are at a floating rate. Therefore, let's say the short-term loans rates rises because it's a floating rate can rise. Let's say it rises. So the bank's interest margin from which it will earn will shrink, right? Because the interest rates have gone higher. The interest rates at which rates of interest at which they reprice the loans at. Okay, hence that will lead to interest rate risk in terms of the repricing risk. So the point as which you reprice, if it's a short-term line item in the asset side, for example, a short-term deposits, and versus for example, a liability, let's say a short-term loan. I mean deposits a liability, short-term loan on the asset side. So the point at which you reprice and the rate at which you reprice them may lead to an interest rate risk of in terms of repricing risk. Okay, especially if one line item or if one rate is sensitive and rises and the other is a fixed rate. Okay, let's also look at the fixed rate deposits via the also the long term. So yeah, so the long term loans and also the fixed term deposits. So 300 million and 200 million. So time deposits, let's say you have customers who have lent to you, I mean, who have saved with you your deposits. Let's say that they want in 1 year, like the example that I gave you, while you have long-term loans that you give out that are supposed to be paid back in, let's say, 5 years. Okay, so if market interest rate rises, as we said, and the cost of deposit, usually cost of deposits, we usually call it that, you won't be able to access cheap deposits anymore. The cost of deposits will rise, while the net interest income you get from the loans you lent out will shrink. So the margin will shrink. That will lead to also a repricing risk in terms of an interest rate risk. Let's also look at the other line items that we listed in the NMB, the National Bank of Malawi's balance sheet: corporate bonds and long-term borrowings here. Corporate bonds, we said, of 150 million. Those are both, we are looking at each items in terms of their duration gap. Yeah. So long-term was 10 years, and also the long-term borrowings of, let's say, 10 years or 5 years. So corporate bonds, let's say you will need to, for example, liquidate them at a fixed return, right? Yeah. They usually at a fixed return, but the long-term borrowings that you borrowed, let's say, are also even for purposes of, or let's say the corporate bonds will be at a floating rate, while the long-term borrowings that you borrow from other banks are at a fixed rate. Therefore, you will be affected by like things like credit risk and also interest rate risk in particular. Since one line item, as it moves, will impact you or your balance sheet differently, leading to interest rate risk in terms of repricing gaps and repricing risk. So such gaps, such for example, repricing gaps, for example, between the short-term line items, assets and liabilities that are rate sensitive, and also the short-term and also even the long-term, and each line item in a bank's balance sheet and in the mix between their assets and liabilities, it will lead to different kinds of risk, especially interest rate risk in the ways we have seen via optionality risk, via repricing risk, and also basis risk. Uh, Especially when you borrow at different rates and also lend at different rates, especially in the interbank market borrowing. So then what can we do? We have seen what we can do in each case. We can use, but we'll also in such a case, we'll look at individual hedging risk and risk mitigation risk we can use. For example, diversification, use of the other futures and options and other risk mitigation and hedging strategies. Okay, that we can use. Just a minute. Yeah, so let's look at how we can hedge our, for example, our treasury department of the bank against interest rate risk, as we have seen in the different ways that it can affect our asset liability mix and lead to mismatches. So yes, let's start with interest. We have talked about it. Let's just recap, and then now in the context of the National Bank of Malawi's and the balance sheet, the hypothetical balance sheet that we just drew. So let's say we want to do an interest rate swap. So we said an interest rate swap is an agreement between two parties that you can swap, for example, between a floating rate and a fixed rate. For example, if you were to pay the customer that lent you the 100 million, I mean, that gave you the 100 million in deposits that you lent out and you are supposed to pay them at a floating rate, then you can enter into a swap agreement to pay them at a fixed rate, okay? But on the amount that, for example, it's called a notional amount, and on the amount that they lent you, okay? For example, if the National Bank of Malawi is paying a floating rate of in the deposits that you give me, for example, I'm the National Bank of Malawi. You as a customer gives me like 100 million, and I'm paying you at a floating rate. But I lend the 100 million that you give me to a customer that will pay back interest in a fixed fixed rate income. Then we can enter into a swap with another party so that I pay, or even with you, to pay you in fixed, but then to receive from the customer I lend to floating rate. So in case interest rate rises, I'll be receiving more while paying you the fixed rate, which is less. Therefore, I will have hedged myself. I will have exactly. I will have hedged myself and made profits. So let's also look at maybe options. So we can set a maximum rate beyond which up to an option is basically a rate beyond which I have the right to, but not the obligation to pay. Okay, but also it can also be a minimum rate. Let's take for example, you give me the 100 million. You as a customer still, you give me, I as the National Bank of Malawi, Isaac, you give me 100 million. Okay, you expect 15% interest return on your deposit after 1 year. But then let's say the 15% is a floating rate. It's not a floating rate of around 15%. Okay. So, but then we can enter into an agreement with you that the maximum, let's set the maximum to be 15%, because we know it's a floating rate, that I should pay you a floating rate, right? So if it's a floating rate, you in that case you are entering into a government expecting that the interest rate may even rise up to 17%. But then we can enter into an agreement called an option that I'll pay you 15% if and only if, that's where the right and obligation comes, if and only if the rate comes to up to a maximum of 15%. Should it go below, I have the option to pay you at 15 still, but I can decide to pay you at 13, which will, let's say the rates climb down to 13. Okay. So you see, is that something you can agree? It depends. Because it's a floating rate. It can also, if you say, if you yourself as the customer says, I don't want your agreement, I want a floating rate. Then you also face interest rate risk. It may even go as low as 12%, in which case you will have lost.
Yeah, right now after
Mhm.
the rate cut.
Mhm. Yeah, exactly. You can expect it. I want a floating rate. So that should it go to 17%, I will have made a lot of. I will have made a killing. But then, on the contrary, it goes down much than you had expected, and then you end up losing a lot of money. So in that case, you can enter into an agreement between me and you, I as the Bank of Malawi, and you as the customer, that I know it's a floating rate, but I will pay you 13% maximum. Or let's say a maximum of 13% and a minimum of 11%. So should the rate be 14% or 15%, I will pay you 13%. Should the rate be 11%, I can decide to pay you 13% out of my own good heart, or pay you at the prevailing market floating rate of 11%. That's basically what option is. And therefore, in that case, I will have hedged myself, and even you to some point, hedge yourself against interest rate fluctuations, what we call repricing risk of interest rate risk. So it will we can set a floor and a ceiling. In that case, the 30% and the 11%. So should the rate go above the ceiling that we set, then I'll pay you the ceiling that we set, that is 13. Okay. Should it go below the 11? Yeah, we can also even agree that I know it's a floating rate, and I know you have the right to even pay me at even lower than we set the floor. I mean, lower than. But then, as a customer, out of my good heart, then I can say, let's set the floor. I won't pay you anything lower than 11%, out of the goodness of my heart. Like just an example, okay? Yeah. So you can also use futures and forwards. So futures are just contracts and on exchanges, while forwards are costly. We can enter into an agreement with you, okay, that should the interest rate be rise to such and such a then I will respond, or I will pay such and such, for example, rate of return. Okay. So we can forward, we can use both futures and uh, we can set, it's basically we set a predetermined rate. Okay. That should should interest rates, for example, be below this, then I will pay you such and such a predetermined rate of, of interest. But then forwards, we can always customize it. And it allows us as a bank, for example, to hedge ourselves against future interest rate fluctuations and the interest rate risk basically. So in that case, as a bank, should the interest rate fluctuation and risk be unfavorable to us, we will have locked before at a predetermined rate, we will have locked the interest rate. And therefore, we will have hedged ourselves and mitigated ourselves against such interest rate risks. Let's also look at how we can now do stress testing in now such an situation over the hypothetical balance sheet. So we'll first start with the identifying. We said during the stress testing, we identify the risk factors, and then we calculate the gaps, and then now we simulate a worst case or extreme market conditions, such as market crashes and bank runs. Okay. and emergency withdrawal. So in such a case, let's say we identify a risk, an interest rate risk that will, let's say the Central Bank of Kenya or the Reserve Bank of Malawi hikes the interest rates, let's say to 17%. Okay, and then so now we will need to calculate from each of the line items in our asset and liability mix. We'll calculate the gaps, the repricing gaps. Whether in that case, for example, in the previous case, we got it to be a net a negative of 0.5 million, right? And therefore, that will lead to a reduction in the net interest income, right? As you see, we just saw one of the banks financial statement. The net interest income was around 121 billion, right?
Yeah.
Yeah. So we can we can even take from that bank and then simulate some scenario. Okay, a worst case scenario. Let's say interest. What if interest had risen to, let's say, 17%? What will happen to the interest rate gaps, interest rate risk, and also the duration, even risk, repricing gaps and risk, and also finally, what will happen to the will it reduce to the NII, that is the net interest income? Will it have reduced or will it increase? Okay, so we just simulate worst case scenarios through forecasting, and then we can hedge ourselves against such worst case scenarios. For example, by diversifying our portfolios, our funding sources, and also even by, as we saw, we can even use some of the instruments, the contracts that we just saw, eh, to hedge ourselves against such interest rate hikes. Okay, and also once we see that we are likely, let's say we do a stress test or a scenario analysis, a sensitivity analysis, where we see that our capital buffers, our NII, the net rental income, will reduce. In that case, we can put appropriate treasury management measures, for example, liquidity management measures, to ensure that our asset and liability mix is so strong enough to withstand such pressures and such market conditions and market crashes and such worst case scenarios. Okay, and to not only to be able to withstand that, but to be able to still be profitable and also to meet our short-term obligations, for example, emergency withdrawals and our short-term borrowings, especially even in the interbank market. So we can build on our capital buffers. We can, as you gave a very good example, we can run campaigns to mobilize deposits, to just mobilize and add on to our capital buffers to be able to withstand the test of time or withstand extreme weather weather conditions, market condition. Why it can even be weather market conditions can even be weather conditions, right? Yeah, because if there is a drought, and then drought will lead to, for example, agricultural produce will be low, and therefore the prices of agricultural produce and the products will increase. Hence, inflation will interest will lead, for example, to defaults in loans and credit risk. Credit risk will interest will translate. So it's all a whole interconnected ecosystem in the economy. So yeah, we once we are able to identify the risk, and then we calculate the capital, we calculate the gaps, the interest rate gaps, and hence the net interest income, whether it will reduce or, and then so now we are able to take the appropriate measures, for example, mobilizing deposits or building on our to build on our capital buffers to be able to withstand to withstand the test of time. Okay. Also, these are not just even these are not just capital management measures by the banks. There are also even regulatory requirements by the country's reserve bank or central bank, right?
Yeah.
Because, for example, even the central bank or a reserve bank of any country requires you to periodically do these tests. For example, interest rates, risk tests, and submit these reports. They want you, the central bank or reserve banks want you to do periodic tests, periodically, monthly or quarterly, to be able to see if your capital buffers are able to withstand, for example, interest rate risks. For example, you do an interest rate test and as a stress test, and find that your net interest income will reduce, okay, let's say by 0.5. When you submit that to the central bank of Kenya, they'll require you to follow the comply with the Basel 3, for example, requirement that will require you to maintain a capital buffer that is enough for you to meet your short-term obligations. Okay.